Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key pattern here is the purple highlighted mid-March to mid-May shallowy bearish shift pitch walk. The market right now in between the overhead purple middle time, currently 196 1/4, and a purple lower time below, currently 184 3/4. With changeover in mid-September, prices gapped higher, but only as far as the middle time, before edging slowly lower, filling in the gap, and now back to levels seen pre-gapping move up and testing towards the lows of September. This bearish shift pitch walk continues to be an excellent indicator of the market's overall bearishness, though we are now approaching those lows that saw a resurgence higher. So I would suggest some caution, as it could be, as I said 4 weeks ago, about under the September lows that, and I quote, "We don't seem to have anything that significant as support until the August 2020 low at the 196 1/4 area," end of quote. One final feature I'd like to draw your attention to, and that is that we don't have any easy recent bear channel here as we have seen in other markets. But we do have a small mid-September based downtrend, currently at 194 1/4. What is interesting about this downtrend is that the declining green short medium moving average, currently also 194 1/4, is running in step with this very, very closely. Minneapolis wheat. The market in the most recent action has formed what looks like a small late September to date descending wedge pattern, currently 562 to 570 1/4. A quite steep declining wedge after earlier between changeover mid-September to early October, forming a small double top pattern. The subsequent decline saw both primary and secondary targets for this pattern fairly easily achieved. The larger medium-term pattern had been a very lopsided late May to mid-July head and shoulders top, with quite a cute angled bright red neckline above the market, currently at 581 1/4. The primary and secondary targets for this pattern had likewise also been achieved, though I do note how the market has seemingly utilised this neckline much as a bearish angle of attack and has not strayed too far away from it, and when it has, it's quickly come back towards it. This brings me to a larger point, and one I've spoken about 7 weeks ago when I said, and I quote, "We are also possibly on the threshold of a really big pattern, a December 2024 to date possible cat's ears pattern. This is a bearish pattern, but the discussion for this, which I have postponed for a couple of weeks, may be coming up, and real soon, as we're about to trigger the downside opportunities for such a pattern. It is a long-term pattern, but I urge you to keep remembering this idea as if we travel and stabilize a little lower than where we are, I may feel obliged to deploy it along with all its ramifications," end of quote. Now I stand by this, and I've watched the developments around the gapping action and now the move towards the lows of September with great interest, as we are getting closer and closer to triggering this pattern. London UK feed wheat. Okay, so there had been on this daily chart until early July and running for about a year, one major significant pattern here, a pattern we have not seen in the other grain markets. I still have this on my daily chart for a reason, and the pattern is the bright red late May to early July 2024 bearish shift pitch walk. In early July this year, due to changeover, we had a very large gapping move higher, up and out of this pattern beyond the bright red upper time, which is currently at 162.20. Now please remember this level, and also the idea of the bright red upper time, as it will show up again shortly. Now added to this upper time, we had higher up the important, even today, 50% absolute Fibonacci line at 180.5. And you had there, and even now still have, an area overhead that is a significant resistance, as it capped the market on its rise back in July, with some added nearby help at the time from the purple July 23 to date downtrend, currently at 179.25. Since that peak, we've seen prices ease lower, moving eventually below all the moving averages yesterday and penetrating, that's on Thursday, and penetrating but not pushing below the bright red broken upper tine. Currently seemingly happy to slide along the top side of the bright red upper tine, just sliding along the top of it. What is important, or more important, is that we are establishing below the very, very important dark blue neckline extension to a pair of very long-term patterns, which I will detail now. Both these long-term patterns necklines are currently at 168.30. This week's actions solely below this dark blue neckline almost but not quite led to a weekly key reversal, the market in the end adopting a lesser outside weak pattern. I've also drawn a bright new green late January to mid-July bearish Andrews pitchfork to show the new bearish angle of attack. The upper tine fits for now, and that's currently at 141.55, though I am not fully sure about this pitchfork, and I may finesse this to a shallower bearish shift pitchfork for the same move at a later date. This all leads me to my final points, the same points I've been discussing now for months, and some of them was something that I noted back in my annual commentary back in January this year on London Feed Week. To see these, it is best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top, formed after a big fall such as the fall we had earlier in 2023, as well as an even longer term second pattern. August 2020 to date, very large head and shoulders top. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart. And that's currently 168.30, and that's the same as on the daily chart I just spoke about. Thus, a primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, just below the bright red and big old 2005 to-date uptrend, currently at 132.15. A secondary, harder to reach target X4 will be down in the 112.85 zone, around where the shallow dark blue lower trend line is, currently at 114.15. That's for the 2007 to 2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts, and that's the 1975, yes, a half-century old uptrend, 1975 to date uptrend, currently at 66 even. I'm not even going to give you my secondary target to achieve, the harder target to achieve for this pattern as it's below zero. Please, please, please bear in mind that these are very long-term targets, stretching possibly over many years, but they are still targets below for these patterns that you see above. Now, that all being said, July with changeover threw a major spanner in the works for such longer-term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the newly drawn 2023 to date upper bear channel line. It's currently 180.15. The question this posed, and it's a longer term question, is whether this was just a reactionary single month move higher or the beginnings of something else. Once again, as in my previous commentary, I will continue to stick to the reactionary single month move higher, but I'm prepared to start looking at the possibility of a new base of support. It's only being built but also being exploited for a possible move higher. There is one caveat to this basing higher idea, and is one I've already mentioned, and that's the newly drawn mid-23 to date big bear channel, currently at 132.90 to 181.40. Even with such a big reactionary move back up, we are still sitting within this bear channel, this big bear channel, and it does have the advantage of already having had at least the minimum 5 touches necessary to legitimize it. For all this discussion, we are still dealing here with some very long-term patterns, and please bear that in mind always. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.